Do you settle for average returns? Why do you do this? There are so many ways you can outperform the market. Most people will miss out on huge opportunities simply because they don't know how to gain a real edge when trading. Today I want to share with you some practical ways on how you can get a real competitive advantage when investing. And no, it's not about having insider information, getting lucky with risky trades. It's about using smarter strategies and techniques most investors completely ignore. So what's the first way you can get a real competitive edge when investing? Step 1. You need to understand market cycles and timing. Markets don't move randomly. There are patterns and phases such as expansions, peaks, contractions, and troughs. Most people are not well versed when it comes to investing with the market. The most important thing you need to cement into your mind is that the market is simply always right. That means you don't buy when you want to buy or sell when you want to sell. You do exactly as the market tells you. You always need to be reactionary. If you are in a bullish trend, you should buy. If you're in a bearish trend, you don't. If the overall market trend is down, the chances that you are going to pick a great stock is very small, and one that will actually give you returns. It also puts your mind at ease. The market is your guide, and you simply follow along. During the 2008 market crash, and more recently during the 2020 crash, those who understood market cycles were able to cut losses quickly and sit out while others were buying into stocks. And when the market signaled it was recovering, they were back in. You should use these phases to your advantage. So what does this mean for you? How can you practically implement this so you can gain an edge? You should pay attention to the economic indicators. In stock trading, focus on the 4 big indexes, such as the S&P 500, Nasdaq, Dow Jones, and the NYSE Composite. The simplified version is that when they are moving up and are above their 21-day and 50-day exponential moving averages, you are free to buy high-quality stocks that you have chosen. If they, however, are around or below these levels or declining, don't risk it. You are asking for trouble. Additionally, develop a watch list of stocks you're interested in during these downturns, so you are ready to act when these opportunities arise when the markets eventually turn up back again. Step 2 is to focus on industries and moats. Another great way to get an edge by investing is to look at something called economic moats. A moat means that a company has a significant competitive advantage that protects them from their competitors. Think of it like a castle, a moat. It's hard for others to invade it. Companies with strong moats dominate their industries, and when you invest in them, you're setting yourself up for success. An example of this is to think of a company like Google. Its moat is search. Google has become synonymous with finding something on the internet. People are more likely to say Google it than search for it, for example. No one realistically is going to replace them anytime soon. They have a massive advantage because of their market share, brand recognition, and data. Investing in companies like this can give you a solid edge because their dominance makes them more stable. Now, this is just one factor to consider when buying a stock, so please do additional research if you're investing in such a company. Economic moats can come in various forms, such as brand strength, patents, networks, cost advantages, and regulatory advantages. For example, a strong brand like Coca-Cola has a loyal customer base that competitors will find hard to lure away. So what does this mean for you? To gain a practical edge here, you should focus your research on companies known for having a strong moat. Look for brands with significant market share, innovative patents, or customer loyalty. Just something unique that sets them apart. You can use tools like Morningstar that can help you identify stocks with strong competitive advantages. Once you find a company with a strong moat, you are that much more likely to beat any other investor just investing for arbitrary reasons. Step 3 is you can use asymmetrical risk-reward opportunities. To really gain an advantage, you need to understand asymmetrical risk-reward opportunities. This means finding investments where your potential gains far outweigh your risks. Most people think it's about avoiding risk altogether, but smart investors know that some risks are worth taking. That being said, when the rewards are disproportionately higher than the risk. Ideally, you should aim for a risk-reward ratio of 3 to 1. This means for a $100 investment, you deem it acceptable to lose $10 in that investment. Therefore, you need to ensure that the stock rises to at least $150 to take a $30 profit. That's a reward to risk of 3 to 1. Let's make an example. Imagine you start with that $100 portfolio. Here's how the trades will break down. If you make these trades with this strategy and win one trade whilst losing two, your results would look like this. So you win the first trade, that's $30. Your portfolio grows to $130. Now you lose the second trade, that's minus $13. Your portfolio decreases to $117. And you lose the third trade, $11.7. Your portfolio decreases to $105.30. So after these trades, you still made a profit of $5. Now what if you didn't follow this model? We start with the same $100 portfolio. Here's how the trades break down. If you make 3 trades with this strategy and win one trade while losing 2, your results would look like this. So again, you win the first trade. That's $10 in your pocket. Your portfolio grows to $110 and you lose the second trade. That's minus $11. Your portfolio decreases to $99 and you lose the third trade as well. That's minus $9.9. Your portfolio decreases to $89.1. So after all these 3 trades, you lose $11. So you see, asymmetrical risk-reward opportunities involve scenarios where the potential upside is significantly greater than the downside. This concept is crucial in venture capital, where investors fund startups with the hope that a few will become highly successful, offsetting the losses of the others. In public markets, you can apply this by investing in sectors or companies with high growth potential. By carefully assessing the risk and potential reward and diversifying your investments, you can capitalize on these opportunities. So what does this mean for you? We can use the dividend discount models or growth models to value the stock's true value and see if the stock has a 3 to 1 potential. If not, stay away. To implement this practically, start by identifying sectors with high growth potential. Focus on companies that are innovating and solving significant problems. When you spot these opportunities, conduct thorough research to assess the potential reward compared to the risk involved. Another step you can take is to take advantage of behavioral biases. Most investors will make emotional decisions. They get excited when the market heads up and get panicked when the market heads down. This will create opportunities for you to gain an edge. By understanding these opportunities and taking advantage of them, you can buy when others are selling out of fear and sell when others are getting greedy. Let's look at an example. Let's take the 2020 market crash again. Everyone started to panic and sold their shares, but those who understood market cycles and stayed calm made a killing when the market rebounded. The lesson here is that you shouldn't get caught up in the herd mentality. Use other people's emotions to your advantage. Behavioral biases like fear, greed, and herd mentality can lead to irrational investment decisions. Fear will cause investors to sell during market downturns, locking in losses, while greed can lead to buying at market peaks, which is the risk of buying stocks that are overvalued. Herd mentality will also drive people to follow the crowd and what they are doing, often resulting in buying high and selling low. Now, if you can recognize these biases, you can make more rational decisions. For example, this is how you can implement it. During a market downturn, instead of panicking, you might see it as an opportunity to buy, when the market eventually gives you those signals. The fact of the matter is, even when the market has recovered, many inexperienced investors may still be wary to act because of the scare they had just gotten. So what this means for you? To apply this practically, develop a clear investment strategy. You need to do what the others aren't, regardless of the emotions that you're experiencing in the moment. Become sort of like a robot. What really helped me was just not getting too excited when I made a profit, and not too bummed out when an investment flopped. And this is the crucial part. You should set predefined rules for when you're buying and selling based on your analysis, rather than letting fear or excitement dictate what you're going to do. If the market is down, use it as a chance to evaluate and potentially buy quality stocks at lower prices. Conversely, during market highs, be cautious and consider taking profits or rebalancing your portfolio to avoid overexposure. to those overvalued assets you may have. And the final step you can take is to focus on critical indicators and streamline your research. Now this one is where you can save a ton of time and still gain an edge. By focusing only on the most critical indicators and using faster research tools. Most investors will get bogged down by irrelevant data that really isn't important when choosing a great stock. But if you can concentrate on a few key metrics, you can quickly identify the strongest stocks without wasting hours digging through reports. Let's take an example. Instead of you looking at every possible piece of financial data, focus only on the critical ones, such as profit margins, return on equity, or EPS growth, to name a few. It might seem like the right thing to do, but more isn't always better, because you need to consider your time as well. Imagine this. What if you sit an entire day going over a stock's financials, only to end up realizing it's a bad investment? I count that as a waste today. Now on top of that, using stock screeners or platforms that filter out stocks based on these metrics can drastically cut down your research and really help you zero in on the best opportunities faster. So what does this mean for you? To implement this strategy effectively, you should create a list of the most critical indicators that matter to your investment strategy. Utilize stock screeners and financial news apps to set alerts for when stocks meet your criteria. This will allow you to quickly identify and act on investment opportunities without sifting through irrelevant information. So there you have it. Now's the time for you to take action. You can implement any of these steps today. Investing isn't that hard. Also remember that success in investing doesn't happen overnight. You need to start somewhere. And with these tools in your arsenal, you'll be on the path to outperforming the market. And I'll see you in the next one.